Okay, what is up, traders? What's up, tycoons? Super excited for today's video. Lots of people are speculating that the Fed has made their last rate hike, right? And so, what we're going to do in this video is actually go over what happens after a Fed rate hike or a pause, okay? Now, investors might finally be able to unfasten their seatbelts as it appears interest rates may have reached their cruising altitude. In May of 2023, Jerome Powell and the FOMC voted to hike their target rate range by 25 basis points. This marked the 10th consecutive rate hike for the Fed. But what might be more important is that officials removed language suggesting that additional policy firming may be appropriate, meaning this could be the final rate hike of the cycle if the Fed sees encouraging signs from upcoming data. So we're going to go over all of this real quick in a nice video for you guys. Make sure to smash that like button and subscribe to the channel if you guys are new, and we'll go ahead and dive further into it. Now, since the Fed's hawkish period started in March of 2022, U.S. inflation has come down from a more than 40-year high of 9.1% to 4.99%. The S&P 500 ended the year down 18% in 2022, but had rebounded 7.5% at the end of Q1 2023. Although U.S. inflation is still higher than the Fed's 2% target, other cracks in the economy, including 3 major bank failures this year, are being taken into consideration when determining the Fed's next steps. Fed officials also stated that they expect no rate cuts to occur until at least 2024. To put this cycle into context, the target federal funds rate went from 0% to its highest level in 15 years in a span of just 15 months. On the surface, the Fed funds rate may seem like just one interest rate out of the many that exist in our complex financial world. However, there's an old investing mantra that goes, don't fight the Fed, meaning it would be wise to align your investment choices with the actions of the Fed. With that in mind, how powerful are the Fed's decisions regarding monetary policy? What kind of effects do those decisions cast? And how certain do markets and sectors of the economy react to changes in the Fed funds rate? And now that we're also possibly at the end of this hawkish cycle, what might that mean for investors? Now, what is the Federal Reserve and the Fed funds rate, you may be asking? The Federal Reserve was created in 1913 under President Woodrow Wilson through the Federal Reserve Act. Known as the Fed for short, the Central Bank of the United States serves several purposes ranging from promoting stability in the financial system to regulating financial institutions and their activities. One of the Fed's major functions is setting U.S. monetary policy in order to achieve its dual mandate set by Congress, which is maximum employment and long-term price stability, i.e. inflation, in the United States. Monetary policy is set by a body within the Federal Reserve called the Federal Open Market Committee. This is the FOMC. Now, the FOMC usually meets 8 times a year to review economic and financial conditions and vote on changes to monetary policy. Policy is typically implemented via changes to the Fed funds rate, the benchmark rate at which financial institutions lend to each other. If the FOMC deems that macroeconomic events warrant an increase to the Fed funds rate, such as inflation outpacing the Fed's long-term target of 2%, the committee would raise the Fed funds rate to prevent the economy from overheating. If the economy appears to be stalling out, the FOMC may attempt to spur economic growth by lowering its target rate. Whether the FOMC votes to raise the Fed funds rate, lower it, or keep it unchanged, each decision produces winners and losers throughout the economy. So which assets are most impacted by changes to the Fed funds rate? We'll go ahead and start by talking about bonds, right? So how are bonds affected by Fed rate hikes? Short-term treasury bills and the yields they can offer are most directly affected by the Fed's monetary policy as stated by the Fed itself. Though any fixed income instrument is subject to the ebbs and flows of the open market, short-term treasuries have historically moved in near lockstep with the Fed funds rate. This relationship is strongest for the 1 month, 3 month, 6 month, and 1 year T-bills. Long-term treasuries like the 10-year note and 30-year bond don't typically follow the Fed funds rate as closely, though they have trended along its general direction over the last 30 years. This is because the Fed does not directly target long-term interest rates, and the maturities on these instruments are denoted years or even decades out in time, meaning their purchase prices and yields are subject to greater and more numerous potential risks. It's important to note that bonds market volatility bonds market values typically decline as rates go up. In a rising rate environment, new bonds offering higher interest payments will be issued, causing existing ones to decline in price. If rate hikes were to pause, the prices of existing bonds could stabilize or even regain value as their yields become increasingly competitive in comparison to newer offerings. And we have a nice chart here to the right with the Fed funds rate in the orange, right? And then we have a look at some of the different treasury rates. We have the 30, 10, 1, 3, and 1 month treasury rates. And we can see how these are affected by the effective federal funds rate and how they fluctuate, up and down, also according with, their timeline, right? Whether it's a longer term, such as the 30-year, or a very short term, such as the 1 month treasury rate. Now, how consumers are affected by the Fed rate hikes is via four ways. Okay, you have your prime loan rate, you have credit card interest, you have mortgage rates, and you have your savings accounts and CDs. So, the first one we're going to dive into here is the prime loan rate, and this measures the rate at which banks lend to their most credit-worthy clients. A rule of thumb for calculating the prime loan rate is the target Fed funds rate plus 3 points equals the prime loan rate. The U.S. Bank prime loan rate is strongly correlated with the Fed's fund rate and tends to move along with it, as seen in the chart over here. Any further Fed rate hikes are quite likely to increase the amount prime loan rate borrowers are charged. If rate hikes were to pause, the U.S. Bank prime loan rate may stabilize or even experience a slight decrease, leading to more predictable borrowing costs for consumers and businesses, potentially stimulating economic activity. And we take a look over here, we have the effective federal funds rate in purple and the US Bank prime loan rate in orange. And we can see that they are very closely correlated in response to each other. Now, credit card interest is another one. Changes to the Fed funds rate can also influence credit card interest rates, known to all of us as annual percentage rate, which is your APR. The relationship between the Fed funds rate and credit card interest rates is relatively strong historically, but since 2003, the average APR has been less directly affected by rate changes. While credit card interest rates rose with the Fed funds rate starting in 2015, they lowered only slightly when the Fed cut rates to 0%, unlike previous low or zero interest periods. Credit card interest rates might not experience a significant change amid a pause in rate hikes due to their less direct correlation with the Fed funds rate since 2003. Nonetheless, a pause in rate hikes could potentially alleviate some upward pressure on APRs, providing relief to credit card holders and encouraging consumer spending. And so we have the Fed funds rate up here in purple, and we have the U.S. commercial bank interest rate on credit card plans for all accounts in blue. And we can see that both of these have been on a really large spike as of recently, right? And we're seeing a large increase on the U.S. commercial bank interest rate as well as the effective federal funds rate. Okay. Now, another one is mortgage rates. So the prevailing 30-year mortgage rate and its 15-year counterpart tend to follow the 10-year treasury rate more so than the Fed's fund rate. Mortgages are backed by bonds and securities, which align more with an instrument like the 10-year treasury. The Fed doesn't directly target long-term instruments, but since rates of most shapes and size experience a ripple effect from the Fed's actions, mortgage rates tend to do the same. Since February of 2022, the 30-year mortgage rate has climbed 2.5 percentage points to 6.39%. If the current rate hike cycle ends, the 30-year mortgage rate and its 15-year counterpart might experience a period of stabilization or even a slight decrease, as the 10-year treasury rate could also stabilize or decline. This could lead to more favorable mortgage conditions for home buyers. Now, I personally have some friends that are, real estate agents, real estate brokers, as well as mortgage brokers, and I know that they definitely look at the 10-year treasury. So if we take a look at this chart here, again, we see the effective federal funds rate in purple here. We have the 10-year treasury rate in green, the 30-year mortgage rate in blue, and the 15-year mortgage rate in orange. All right, and we can see how they are correlated with each other and how the Fed fund rate affects the different rates, whether it's the mortgage rate or the treasury rate. Now, savings accounts and CDs are one group that stands to benefit from Fed rate hikes, are savers or depositors. When banks compete for individuals' deposits, they often incentivize potential customers by raising interest rates on saving accounts and certificates of deposits. CD rates rose in response to Fed rate hikes in 2015 and through 2019, though they fell to extreme lows when the Fed funds rate went to zero in 2020. Nevertheless, the rates on savings accounts and CDs would be poised to receive bumps as the Fed funds rate is raised. Nevertheless, rates on savings accounts and CDs are seeing a bump as the Fed funds rate is being hiked. During this rate hiking cycle, many investors began parking their money because of competitive yields, evidenced by the $439 billion that flowed into money market funds in Q1 of 2023. In the event of a pause in rate hikes, however, savers might see a period of stalled interest rates on savings accounts and CDs, as banks would have less incentive to compete for deposits with higher rates. In response to the slower growth of interest rates, individuals could potentially seek alternative investment options to achieve better results, which might impact the overall investment landscape. Okay, and so what we see here is, the Fed funds rate in this graph, also with, a range of dates in, commercial deposit rates, okay, and CD rates. We have the 1 month, 3 month, 6 month, 1 year, 2 year, 3 year, 4 year, and 5 year. And we can see, as the Fed funds rate went down, we see a drop in the CD rates. And then as the Fed funds rate has increased, we also see an increase in the CD rates, right? Now, how are stocks affected by Fed rate hikes? When the Fed raises rates, the cost of borrowing increases for businesses as well as individuals. Higher costs and cutbacks on capital expenditures could mean lower top and bottom lines for corporations and thus reduced stock prices. Companies that rely on cheap access to capital, often growth-focused companies, may find it more difficult to finance expansion and therefore become less able to justify their current valuations. Stocks have thrived significantly in previous low-rate environments. In addition, the stock market started picking up steam as the Fed funds rate fell from its peak in 1981. The S&P 500 has risen 8.6% on an annualized basis since then, but with the index's dreadful 2022 in the rear view, investors will be watching to see how the ongoing rate hike cycle affects the market's directions. Of note, equity investors may still welcome a Fed rate hike if it's meant to combat the strong headwind of rising inflation. A pause in rate hikes could help maintain or even boost current market momentum, offering opportunities for investors to capitalize on equities and providing companies with more attractive financing options. However, if the pause in rate hikes unsuccessfully addresses rising inflation, it could erode the real value of returns. A restart of hikes may make investors less eager to invest in equities. And we see here the Fed funds rate, all right, and we see the peak here that we had on the top of the effective federal funds rate. And really since then, the S&P 500, which a lot of people refer to as the stock market, has been on a really, really tremendous rally since that peak in the effective federal funds rate back in the 80s. Now, comparing the two-time rates were raised from 0%, in December of 2015, the Fed began raising rates from the 0.0 to 0.25% target in light of sustained economic activity, a continued decline in unemployment, and expectations that inflation would rise to a 2% average. 3 years later, the Fed stopped raising rates at a target range of 2.25 to 2.5% after inflation hovered around that 2% target for several months. The Fed gradually raised rates in 25 basis point increments through December 2018. Now, this cycle has seen the Fed raise rates more aggressively. This recent cycle included 75 basis point hikes on 4 occasions between May and November of 2022, along with a couple of 50 basis point hikes at both ends of that time frame. After its most recent rate hike, some analysts believe the Fed has reached their terminal rate projection of 5.25%. Because the Fed funds rate has been set to zero only twice in history, 2022 also brought the second instance ever in which the Fed has raised rates from 0%. With all this in mind, how have different asset classes and indicators fared under the rate hike cycle of 2015 to 2018 compared to 2022? What happened to stocks when the Fed fund rate was raised from 0%? After the federal funds rate effectively reached 0% at the end of 2008, U.S. stock indexes entered a bull market that would last more than a decade. It was a largely uninterrupted bull market for the Dow Jones Industrial Average, S&P 500, and especially for the growth-heavy NASDAQ, thanks in part to the cheap money provided by near zero rates. Around the time of the initial rate hikes in 2015, the indexes fell sharply on back-to-back occasions, but then continued to charge higher for a number of years during the Fed's rate hike cycle. When rates reached 2% in 2018, there was a sizable correction late in the year. That correction also occurred just before the Fed ceased raising rates at 2.5%. At the onset of the COVID-19 pandemic, when the Fed lowered its target range to 0.0 to 0.25% once again, the indexes switched back into bull market mode. Largely mirroring what happened at the end of 2008, the Nasdaq outpaced both the Dow and S&P 500 while rates were at 0%. In 2022, the market started turning south just before the Fed began raising rates, partly because the Fed has become more vocal about their future plans. Though stark differences exist between the economic climates of the two rate hike cycles, inflation reaching over a 40-year high in 2022, among others, the Fed's moves sent jitters through the market in both cycles. Now, what happened to bonds when the Fed funds rate was raised from 0%? As the Fed gradually raised rates starting in 2015, short-term Treasury bills moved higher in tandem, while long-term bonds rose marginally as well. After the Fed rapidly raised rates in 2022, Treasury yields of all shapes and sizes are shot higher in response. And we can see that here on our chart, again, going over the effective federal funds rate and taking a look at some of the shorter terms, such as 1 month, 3 month, and 1 year, versus the longer term 10 and 30-year Treasury rates. And what happened to consumers when the Fed funds rate was raised from 0%? Well, the interest rates on prime loans, mortgages, and credit cards all rose with the federal funds rate during the hikes of 2015 through 2018. As mentioned earlier, mortgage rates have more closely tracked the 10-year Treasury rate. When the Fed stopped raising rates in 2018, mortgage rates actually fell. This was due in part to the Federal Reserve's own concern over the possibility of slowing economic growth in 2019. With increased talk of a recession among both CEOs and the American public, could mortgage rates repeat history and trend downward opposite to the trajectory of the Fed funds rate? That's an interesting perspective to think about. Again, what we have here is the effective federal funds rate. We have the U.S. bank prime loan rate, 15-year and 30-year mortgage rates, along with U.S. commercial bank interest rate on credit card plans for all accounts. Now, the bottom line is the Fed may be nearing the end of raising its benchmark Fed funds rate in an attempt to control inflation and stabilize prices in the U.S. The changes to this rate caused a variety of effects throughout financial markets. Some areas of the economy felt head-on impacts from the Fed funds rate, while others experienced lighter ripple effects. What investments you own or are seeking to acquire, it pays to know the impacts of the Fed's fund rate so you don't find yourself fighting the Fed. Thank you guys for watching today's video. Smash that like button, subscribe to the channel if you guys are new, and I'm out.